For joining us for this month's National Economic Outlook, written by Local Market Monitors founder Ingo Windsor. Ingo is a graduate of MIT and Boston University, and he's not your local typical economist. He has a knack for presenting complex facts in an easily understandable way. So without further ado, I'll turn it over to Ingo.
Thank you, Julie. Every month, we look at the latest economic data to see what they can tell us about real estate markets, where they are now, and where they may be headed. You make better investment decisions when you have a better idea of the economic forces that affect supply and demand. This month, in addition to reviewing the situation of the overall economy, we'll look at some interesting indicators of demand for real estate. Let's start with jobs, our best indicator of how the economy is doing right now. It's especially important for real estate because more jobs means more demand for housing. This chart shows the increase in jobs in the U.S. economy every month compared to the same month of the previous year. The latest data point is February. After a long period of rehiring for jobs lost during the pandemic, the rate at which jobs are now being created is a bit more than 1% a year. This isn't bad, considering the slow pace at which the U.S. population is growing, but it shows how much the economy has changed from the times when job growth of 3% a year was normal. We'll see later that even this low rate of growth may be misleading in terms of how well the economy is actually doing. During this period of fairly low growth in jobs, this is what has happened with home prices. This picture shows the increase in the average sales price of a home every quarter compared to the same quarter of the previous year. It's a very unusual picture because a boom in prices like this is almost always followed by a bust. But that hasn't happened so far, with further price increases bumping along at about 5%. The average home price today is about 30% higher than in 2020, in the middle of the pandemic, when the boom began. What brought the boom to a sudden end was the increase in interest rates in 2022, as the Federal Reserve tried to fight inflation. Normally, the Fed raises rates to curb rising demand, but this time the problem was lower supply. Mortgage rates doubled and demand for homes was cut sharply because few people wanted to buy a home at those prices, and even fewer could qualify for a mortgage of that size. With new government policies, the prospect of lower interest rates this year is becoming remote. Let's have a look at how high interest rates have affected demand for real estate. Here's one picture of job growth in construction. There's been a steady slowing of jobs for new construction projects, even for non-residential buildings like schools, data centers, and Amazon warehouses. The effect is even sharper for jobs in home construction, where there currently is almost no new hiring. Normally, higher home prices boost the construction of more homes, but this chart shows that demand is falling. This is most striking at real estate agencies, where jobs have been lost for the past 2 years and at an increasing rate. Instead of high home prices indicating strong demand, they now have frozen demand, and it's very likely that this picture will not change much in the coming year. From here, let's take a quick spin through the major sectors of the economy to see which ones are creating new jobs and which ones aren't. The manufacturing sector has been losing jobs for the past 2 years, despite government efforts to bring them back from overseas. This won't change anytime soon because it takes years for businesses to relocate or to set up new operations, even when they have a strong incentive to do so. The finance sector had a spurt of new jobs from the housing boom, but that came to an end. Because banking now is mainly consumer banking, job growth that's faster than population growth is unlikely. The retail sector is large, but has produced no new jobs. Restaurants have finally recovered from the job losses of the pandemic, but their growth also is limited by the growth of the population. Jobs in government also have recovered from pandemic losses, especially at state schools. Most government jobs are at the local and state levels. The federal share is smaller, but efforts to trim the federal workforce could reverse job growth in one of the few sectors that has been adding them. Healthcare is the one sector that has been adding jobs at above average rates. Normally, job growth in healthcare is about 2% a year, rather than the 4% we're at right now. Without this extraordinary growth, which can't last, overall job growth in the economy would be less than 1%. The greatest concern about the economy is seen here: job growth in the big business services sector, which provides services that all businesses need and is our best indicator of actual business activity. It's been losing jobs for 2 years, which indicates that businesses are hunkering down rather than expanding. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. Local Market Monitor provides the data and analysis they need with local market reports and investors' metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.